All right. Hello again, everybody. This is Mike Rixey. I'm the lead options instructor for NetPicks, and this is our weekly options recap. We'd like to jump on here towards the end of the week, walk you through some of our trading this week, some of the trades that we've closed out. We'll also highlight some of the trades that we're looking at going into next week. Today's a little unique in that I'm going to give you a sneak peek into a brand new setup that we have just started to implement here on our side. It's been in the testing process for months. We've been using it in-house here for months. We just started here recently to use this setup with our signal services, and they have these trades have been doing really, really well for us. So I'm excited to show you what we've been working on here, and we'll get to that in just a moment. As always, if you have any questions throughout the session here today, feel free to type those in into the chat. If you're live, if you're watching the recording here on Facebook or YouTube over the weekend, feel free to email me directly, mike@netpicks.com. I am more than willing to connect and help out with any issues, questions, comments. We can certainly connect and help out there. All right, so let's talk about another week. Let's talk about markets, a big picture here. As we go into the weekend, we've got another new all-time high. It's just been the case now for the last number of months. I mean, every single week, it seems that we close the week right up at all-time highs. The high of the session today on SPY 422.82, that is indeed an all-time high. So up above that level, where do we look at? We have no previous reference points, right? We have no previous moves to look at. So our focus shifts to the big round numbers and the big 0.50 levels. 423, 423.50, 424. Those would be the next areas on the upside that we could potentially look at for areas of resistance. On the downside, it's very clear, right? I mean, as strong as this market has been, we have had a few dips here over the past week. But what's interesting is these dips are really respecting the technical levels perfectly. If we go back to late April, we had price action come back on the daily chart and test the 8-period exponential moving average, that solid pink line. We, in fact, tested it 4 days in a row. That level held every single time, and we bounced right back to the upside. Fast forward here to the last week, and we've actually seen price action dip down and test the 20-period, both the simple and the exponential moving averages, the green lines on my chart. We tested those levels early in the week. Those levels held. And what we have been seeing is when those levels hold as support, we have seen them lead to just a trampoline effect where we jump right back to the highs. And this is another example of that here this week. Now, the volume has not been great on the upside. That has been the story now for quite some time. The market doesn't need volume to move. But what's interesting is that as we start to get back into this grind higher, the volume continues to contract. And it's been a struggle here on these moves to the upside to get 50, 70 million shares to trade on a daily basis. What I would ideally like to see is when we get that 100 million share level reached on a consistent basis, it's a much better environment for all of us, day traders and swing traders alike. So I want to see things open up a bit. I want to see the volume pick up. That's something I'm going to be watching closely next week. We're just about through earnings season. So we're going to get back to more of a technical trading approach, right? Where we're focused on the technical levels on the chart, not so focused on the headlines. The ATR down at the bottom came to life a little bit. We're still below 4, just slightly. I want to see that average true range uptick. Ideally, between 4.5 and 5 would be a good range. What we're seeing now is when you get the ATR to dip below 4, it's a much tighter range intraday. You don't have as many big moves back and forth to work with. We saw the ATR uptick slightly this week. We had a couple of sessions where we had some good movement back and forth, but big picture, just not much going on down here. Nothing compared to what we were seeing back in March and early April. So I want to see that ATR come to life a little bit going into next week. The VIX getting hit again today down near the lows of the session, down at 1729, continuing to suck the fear out of this market, which makes perfect sense, right? I mean, when you have a market that just goes higher every single day, why should there be any fear in the markets, right? We just never head lower. We just continue to head higher. So we've talked about it now for the last number of weeks. When you start to get the market this one-sided, the whole boat is loaded on one side, right? It's a very dangerous place to be. It doesn't matter if it's loaded on the upside or the downside. It's just when everybody gets so focused on one direction, that's when the market historically likes to throw everybody a curveball. It likes to surprise the most amount of people possible. Now, we have seen very little rocking of the boat here lately. I do expect that to change here in the very near future. I fully realize the Fed, central banks worldwide, they're throwing everything they've got at this market. They refuse to let this market head lower. But with what we're seeing in inflation, you guys that are tracking markets, I'm not personally trading commodities directly, but it's something I watch. I mean, look at lumber prices, look at copper, any of the commodities. You take a look at, corn, soybeans, wheat. I mean, we've seen some pretty impressive moves. All of those moves are beginning to be priced in, right? Meaning inflation numbers are starting to pick up in a big way. Those of you that have been to the grocery store, right? You guys have seen it. I mean, it's there. Whether the Fed wants to admit it or not, inflation is there in a big way. So I do believe that's going to start being priced into equities here in the very near future. At some point, with this market just continuing to move higher every week, inflation numbers starting to skyrocket, the Fed is going to have to act. They're going to have to taper at some point. Okay, they're going to have to cut back on some of the stimulus, some of these emergency measures. I do believe they're going to have to eventually raise rates at some point, to try to keep this inflation under control a little bit. So I'm not saying that's going to happen next week, but it's something that, with the markets being forward looking, if they get any type of a hint that that's coming in the months ahead, none of that's been priced in. There's been no fear priced into this market at all. So I do believe that we're going to get a pickup in volatility going into the next week or two. I am not saying the market's going to crash. I'm not expecting that. But I do think some healthy two-way movement. I think we're getting close. We've seen some glimpses of it here the last couple of weeks. We just haven't seen the follow-through for any length of time. I do think we'll get that here over the next couple of weeks, and that'd be a welcome sight. So next area of resistance up above 423 and 423.50. Those would be levels that we want to watch here, potentially this afternoon or even early next week. And then the 8 EMA, that pink line, let me get the exact value of that level. That level is currently sitting at 418.19. So that's going to be the first area that we want to see tested next week if we do get any selling. And then down below that, we've got the 20-period simple and exponential moving averages. So they're sitting at 416.10 and 414.68. Those would be the next areas that we'd want to see broken on a closing basis. Clearly, we can see, testing that level like we saw early in the week, testing it intraday is not enough. We need to see a close below these support levels if we're going to get anything going on the downside. All right, let's talk through a couple of trades that we closed out here today. I know we've got some existing members watching here today. So let's go ahead and take a look at Monster Beverage. This is symbol MNST. And let me actually show the chart here. As long as TradeStation will cooperate for me today and load up the chart. So Monster was actually a trade that we put on, let me see, it was back April 14th, I believe. I'm trying to check that on my performance spreadsheet right next to me. Yeah, so on April 14th is when we initially opened this trade. We came in and we bought the May 21st 90 puts. So the 90 puts out in the May monthly expiration cycle. We went and bought those puts for $1.35, $135 per contract. It was back in this range. It was actually before we started to use this new setup that you're looking at here on the chart. So we got in when price action started to push lower off of the overbought level. It wasn't anything extreme on the downside, but it was enough with a previous setup type to trigger us into a short trade. And we had to survive this drift to the upside, a sideways consolidation, and we ended up holding into earnings, which were out here over the past 24 hours. I don't hold into earnings all that often, but because we had very little additional risk on the trade, knowing that we are in a risk-defined position, I ended up holding to see, do we finally get a push to the downside? Those of you that have been tracking the tech earnings, we've seen it here the past few weeks. The tech earnings have been pretty good. The numbers themselves have been good, but the stocks sold off after the earnings came out because a lot of that good news was already priced in. Markets have been on a tear for the last few months. All of that good news was priced in ahead of time. Once the earnings came out, we did see a lot of those tech stocks sell off. So I was looking for that same type of outcome on Monster. It's been on a tear to the upside. A Monster, the earnings numbers were actually a disappointment, not like tech numbers that blew their estimates out of the water. Monster actually disappointed, and we did get a move to the downside. It's down, the stock's down over 5% today. So it helped our long put position We ended up closing out of the puts today for $1.50. It gave us a very small profit, $15 of profit per contract, about 11% return on our capital. So wasn't anything earth-shattering, but I wanted to show you this because there are times where I talk to students all the time. I talked to a customer here earlier this week. So many people get caught in that trap of determining position size based on what their profit goals are. And I understand it. We all have bills to pay, right? We've got profit goals that we want to reach. But the problem is, and the student that I talked to earlier this week, they were picking position sizes based on what they thought would hit their profit goals the quickest. The problem with that is they didn't look at the risk side of things, right? If you're trading too big, it can lead to big losses, big drawdowns in your account in a big way. Now, a lot of retail traders have not seen any type of move to the downside. If you started trading over the past year, you haven't seen any type of downside pressure. Right? So everybody just assumes, hey, if we do get a down day, no worries. Hold the trade. It'll recover. The market will bounce right back in the next few days. So a lot of people just get comfortable with the fact that, hey, these trades, they're all working on the upside. Why not just continue to ramp up position size? The market's very forgiving. At some point, if you continue to take that approach where you're risking, 15, 20, 25% of your account in one individual trade. I've seen it here this week with people that have come to us looking for feedback on their trading. When you're taking that type of risk, all it takes is a couple of trades and your account's down over 50%. It's very difficult to battle back from that. Fully realize the profits are bigger, but what we want to do is factor our position size using the risk parameters first. Look at the risk side. What am I comfortable risking? The profits will come. If I can keep the risk small, the profits will come over time. Right? If you can keep that risk small, it's much easier to stay patient on your trades. The customers that I hear from the most, the people that if a trade goes against us, the people that will email in or call in, 9 times out of 10, they're asking about that trade out of nervousness because of their risk being too big. If you can keep that risk small, none of us like to take losses. None of us like it when that happens. But when you keep that risk small, it's much more easier to stomach. You can recover it much faster keeping that risk small. Now, I bring that up, a little bit different scenario here with Monster. Why did I close it out today? The options don't expire until May 24th. So you still have a couple of weeks left. If the stock is now selling off like we expected it to, why not just hold and go for the bigger profit? The problem with that is since I put that trade on, that trade was underwater for the first number of weeks. First couple of weeks, we were completely underwater on that position. So battling back and taking an 11% profit, that's a victory. We love that, right? We'll have other opportunities. I'll show you a gold trade in just a moment. We'll have other opportunities to book the bigger profits. But when you're able to battle back, sometimes taking that partial profit, taking that partial loss, it's difficult, but it's necessary to learn how to do that, right? Absolutely necessary. So we took the trade off today. Could I have held? Yes, but with only 2 weeks left to expiration, the trouble there is the time decay is more significant. So I was able to close it out for a partial profit. I didn't want to let this thing go back to a losing position if the stock decided to bounce or if that time decay continued to work against us. So we booked the partial profit and move on to the next trade. Right. The other position that we closed out here today was on GLD. This is the gold ETF. Switch the symbol back to gold here. And let me just show you the new setup. Okay, these are the new indicators that we are using. We just started to use them recently with our signal service. We're super excited about what we're seeing with the results. So what we did, going back to the drawing board, saying, okay, what can we do? Markets have certainly changed. I mean, they've changed over the past 12 months in reaction to all of the stimulus being thrown at the market, all the newer traders that are, stuck working from home and have more time to spend looking at markets. That has certainly changed the overall environment. So what we said is, can we come up with a setup that allows us to benefit from movement back and forth that's a little bit more reactive? It's going to allow us to react faster to changes in directional moves, but it's also going to allow us to potentially benefit from those longer term trending moves as well. It's going to allow us to take multiple trades inside of a trend. Am I saying these historic moves are going to continue indefinitely? No. But what I wanted to do, and what Mark did with this new setup, is we basically get the best of both worlds. We're going to have the potential for reversals in trend, but we're also going to have the potential to get on board some of those long-lasting trends that develop and last for weeks and months at a time. So what we did with our new setup is we came, and you can see price action came down and touched my lower pink line, our lower channel. Okay, our channel 1. So we came down, and as soon as price touched and crossed that level, it marked that level with a white dot, indicating an oversold extreme. From there, I'm looking for price action to bounce, looking for it to move higher. Now, there's a sequence. I won't get into the nitty-gritty details here yet. We'll do that here down the road. But what I'm looking for out of that oversold condition is I want to move back to the upside. I'm looking for a pushback to the upside. We saw the pullback. We tested some support levels. Now we're bouncing back higher. Remember what I said on that daily chart on SPY? Anytime that we get back down and test those moving averages, test those support levels, when they hold, it can lead to some pretty big moves back into the direction of the trend. So here on GLD, we came in and we hit our entry point, which is the series of blue plus signs. And we came and we actually put this trade on GLD back on April 28th, I believe, is when we initially put the trade on. I might be off by a couple of days. I'm trying to pull up my spreadsheet here, trying to go off of memory. So we got into this position. We bought the 167 calls out in the June monthly cycle. So the June options still have plenty of time left to expiration. We're talking about 40 days left to expiration. So we ended up closing the position out today. Why? Because we were able to close out of that long call position today for $6.20. It gave me a $312 profit. That's 101% return on our capital in and out in just over a week. That's huge, right? I mean, we saw the gap to the upside. You can see that the move to the upside worked out perfectly for us. We ended up booking out of the profit, running the register, again, 100% return on our capital. Okay, this is the type of move that we're going to be looking for on a regular basis. It doesn't matter if the market moves up or down. I don't care. Okay, there's so many traders out there, all of the Fed speakers included, right, that just are so determined to keep this market propped up near the highs. I don't care what the market does. If it starts to reverse here over the next week or two, we're now at an overbought condition because look what price did on the upside. We came in and we touched our upper channel, the upper pink line. Once that happens, it indicates an overbought extreme. So now going into the next couple of weeks, we could potentially look for a reversal in the other direction. If price action decides to pull back, if gold decides to reverse, it's overdone on the upside. If it decides to reverse, it would give us the opportunity to play the downside. So really excited about that opportunity. So really nice trade there closed on GLD. Let's take a look at TLT as well. So a couple things to point out before I get into the details on TLT. Some of you might be asking about the overnight pop trades. That's what I typically cover in our midweek update on Wednesdays and here in the weekly recaps on Fridays. Thursday afternoon is a typical time for us to put on those overnight pop trades. We've done it here now for months. We ended up not taking an overnight pop trade yesterday afternoon. Normally we're doing it Thursday afternoon, right around 3:30 with 30 minutes to go in the session. And we're looking to close out of those trades the following morning. The reason we did not take a trade yesterday, the first Friday of the month, we have the big jobs number up, the employment report. It's out at 8:30 Eastern time, so an hour before the equity open. That report has caused some pretty massive moves in both directions here over the years. It's a big deal now because the Fed is basing a lot of their policy decisions off of what is happening in those numbers, in those reports out each month. So I didn't want to put on a trade yesterday afternoon and get caught on the wrong side of a directional move because of a headline out this morning. I'm a technical trader. I like to base my decisions off of price action on the charts. When you get a big headline, like an employment report or a Fed statement on interest rates, it becomes such a wild card. It becomes a guessing game. You throw the technicals out of the window in some cases. So I don't want to get caught on the wrong side of a directional move because of a headline. So as a result, I sent out an alert to our members yesterday afternoon saying, I would love to take an overnight pop trade, but we're not going to because of the employment number out this morning. It's very rare that I would hold off on taking an overnight pop trade Thursday into Friday. This is one of the few exceptions. So we just, obviously we all know what the market's done so far today. It's been a pretty impressive move to the upside, but had it been an immediate reversal, I mean, it was the number disappointed, but the market's rallying. It's just such an upside down world right now, right? This market is rallying because the number was worse than expected. The jobs report was worse than expected, but that means the Fed is not likely to taper anytime soon. They're going to keep the pedal to the metal, continue to pump up this market as much as they possibly can. So yeah, it's tricky. I mean, obviously you could have said, hey, if we would have been in a bullish trade, it would have been a big profit this morning. Absolutely, that is true. Hindsight as a trader, it's always 20/20. But had we been on the wrong side, had the market moved in a big way to the downside, it could have been a messy situation first thing this morning. So anytime that we don't have a very clear technical picture, we're going to go ahead and hold off on a trade. So there's no overnight pop trades to cover here today. One of the new positions that we put on, and we put this trade on yesterday, this is on TLT. This is the bond ETF. I have not traded bonds all that much here over the past few months, and it's really due to what I just got done talking about. The bond market has been so headline sensitive to everything the Fed says, everything central bankers say. Obviously, the bonds are sensitive to anything happening in the interest rate world or in the dollar world. So I haven't done a lot with TLT up until just recently. I actually have a couple of TLT positions on, and this is one that we put on here yesterday. So what happened on the trade, we got to an oversold condition because price action came down and touched our lower channel. It touched our lower pink line. And I can know that because, I mean, we can clearly see price action below it, but I can also see the white dots indicating when price action crossed below that level. That indicates an oversold extreme. That has me interested in looking for a reversal in the other direction, just like we talked about over on gold. So once that happens, I'm looking for price action to confirm. I'm looking for that reversal, and it finally did confirm, and it came up and hit our blue plus signs. Our entry point was at, let me get my TradeStation data window open. The entry point on this setup was at 139.64. It's basically been stuck there for most of this week. We haven't been able to break to the upside, which makes sense. I mean, with what equities have done, bonds have just kind of been in a holding pattern. This is also one of those patterns that we've talked about recently in these videos. It's that coiled spring pattern. We know as price action coils tighter and tighter, at some point, that spring, it's going to want to pop. And that's going to lead to a pretty big directional move, a very tradable move. Now, we don't know when that pop is going to happen, nor do we know in which direction it's going to happen in. Based on the technicals, based on our positioning, we're looking for a pop to the upside. All right, so the entry point was at 139.64. Let me bring up the trade page, and we'll actually show this one in more detail. So what we did is we went out to the June monthly options, the ones with 42 days left to expiration. I open up that expiration cycle. We came in and we bought the 140 calls. They're currently trading for just over $2 per contract. We bought them for $2.65. So TLT down 0.6% today. So obviously we want this thing to reverse back to the upside. So we're into this trade. It's still a valid trade. It could still be taken here. It's a bullish outlook. We're looking for a move to the upside on TLT over the next 1 to 3 weeks. Plenty of volume in open interest. 17,000 contracts have open interest. Almost 1,400 contracts have traded today. So very liquid product. You're not going to have any difficulty getting filled. It is an aggressive trade. Okay, when you buy a call option like that, the only way we make money is if the stock moves higher. We don't have the benefit of time decay helping us like a credit spread. We have to get this ETF to move to the upside. So that's what we'll be looking at going into next week. We'll see if if interest rates become active again, see if we can get a move in bonds going into next week. All right. Looking at a few additional, grabbing my list here, a few additional new trades that are setting up for us. Let's talk about Uber, symbol UBER. This is the 130-minute chart. What we're looking at down here is the pulse indicator, the pulse histogram down at the bottom. It has gone from red to yellow to green. What do those green bars represent? it tells us that price is between a 2 and a 3 standard deviation move on the downside. In other words, we're oversold. It doesn't mean price can't move lower. It just means it's not statistically probable, right? When you start to get into a 2, 3 standard deviation move, less than 2% of all occurrences fall outside of this range on the downside. So can it continue to move lower? Sure, it could. It's just not statistically probable. You're not stacking the deck in your favor if you're looking to continue playing this move to the downside. In all likelihood, out of this pattern, we're going to see a period of consolidation, or we're going to see a reversal in the other direction. Look what happened previously back in early April. We had Uber with an overbought condition. We had the yellow bars on the upside. What happened? Price consolidated and eventually reversed to the downside. It's a very repeatable pattern over time. If I see an oversold condition like we have now, why wouldn't I come in and buy a long call? Well, like we just talked about on TLT, when you buy a long call, it's a very aggressive bullish position. You're looking for a move to the upside, and you have to get that move to the upside. A lot of times people just trade those long calls and long puts because they think that's what's the safest position. It's actually the most aggressive position you can take. Yes, it gives you the most profit potential. It also comes with the most risk. So instead of buying a long call here, I'm interested in selling an out of the money put spread. Okay, and actually we put this position on yesterday. A put spread, selling an out of the money put spread here, what that does is it gives us multiple ways of making money. And let me go over to the trade page and I'll show you what we did. You can see the different ways that we have of making money on the position. So a lot of times people shy away from these credit spreads, and I hear all the different reasons. They're too complex, they're too risky. They're not very complex. All you're doing is trading 2 options at the same time. And credit spreads are actually the safest type of trade you can take. So here's what we did. We came in and we sold the 41 put spread out in the June monthly options. Again, the ones with 42 days left to expiration. All that means is I was selling the 43 put and buying the 41 put at the same time. We collected 53 cents or $53 per spread yesterday afternoon. We sent this out to our members, and that was the price that we got filled at. It tied up $147 of our capital per spread. That's the most I can lose on the position. If I am dead wrong, if we do get that continued move to the downside, that outlier move, the most I can lose is $147. So it's a very safe position because I know what my maximum loss is right up front, and I give myself 5 ways of making money. I make money if the stock moves up, down, or sideways, as long as it stays above 43. The current price of the stock's at $47.25. I've got about a $4 cushion, over a $4 cushion to the downside where that stock could continue to move lower, and I'm okay. The only move that hurts me directionally is a move below 43, which I'm not expecting because the market's already oversold. So up, down, or sideways, I'm okay directionally. I also make money from time decay adding up. Every day that passes, that helps me. And I make money from volatility decreasing. So those are the 5 ways of making money on the position. Any of those 5, any combination of those 5 is going to work out in my favor. So here we are with the stock up 1.33% here today, up 60 cents. And the trade is now priced at 40 cents. We're up about $13 per spread. Have we seen a big move to the upside? No, we're up just over 1%. But because the time decay is also helping us, because volatility decreasing, the VIX we talked about earlier, the VIX is lower on the session. That's all helping me today. We have multiple ways of making money on the position. My target zone on this trade, so when I can buy this thing back for between 13 and 26 cents. Where did I get that range from? That would allow me to keep between 50 and 75% of my max profit. I sold it for 53 cents. If I can buy it back in that 13 to 26 cents range, that would allow me to keep 50 to 75% of that premium that I collected to open up the trade. So this is a neutral to bullish position. We'll see if Uber continues to move to the upside. We're going to make money the fastest if the stock continues to move higher. We just don't need it to. If it just chops sideways, if it kind of drifts in one direction or the other, we can still work with that. But a move to the upside is going to allow us to book a profit the quickest. One more to take a look at is on JP Morgan. I want to take a look at some of the financial stocks. They have been super strong here for quite some time. They've been holding this market together. The energy stocks, the financial stocks, they have been rock solid, while the NASDAQ took a little bit of a breather after their earnings. Well, now you take a look at JP Morgan on the 130-minute chart, and we do have price overbought. How do I know that? Our pulse indicator has gone from red to yellow to green. just like we talked about over on Uber, just on the upside. So now we're overbought. It doesn't mean JP Morgan can't head higher. It just means in the near term, we're at a point of exhaustion. The market's already made a heck of a move. In all likelihood, when we see this pattern, we saw it back earlier in when was that? Late April, actually, is when we saw the oversold condition. What did it lead to? Okay, it wasn't a big move to the downside, but it was enough to give us an oversold reading in the near term, and it led to another push to the upside. So now here we are with an overbought condition. This has me looking for either a pause or a reversal lower. So could I come in and buy a long put? I could, but it's too aggressive. It's going to tie up the most amount of capital, and it only gives me one way of making money. I have to see JP Morgan move to the downside. What if it doesn't want to yet? What if we just consolidate here and just chop sideways? Very possible. So I'm going to take a look at selling an out of the money call spread. So we're going to come in here. We're going to take a look at the June monthly options, again, with 42 days left. And let's go to the 165. I'm going to right click on the 165, go to sell, and go to vertical. So down at the bottom, I would be selling the 165 call and buying the 170 call at the same time. We're just trading two options at the same time with the goal that stock stays below 165. It's currently trading just below 161. So we've got just over $4 of a cushion where the stock could continue to move to the upside and I'd be okay. The only move that hurts me is a big move above 165. All right. So up, down, or sideways, I'm okay. As long as price stays below 165, I make money from time decay adding up and from volatility decreasing. Right now, the spread is trading for around $1.37. If I click on confirm and send, it would have me risking $363 to make $137. It's very typical for us to be in that range of risking 2 or 3 to make 1. Very typical for us. So that this trade does meet our criteria. And I'm okay with that ratio because we do have those 5 ways of making money on the trade. So it's a very forgiving trade. Any type of a sideways move, any type of a move to the downside, time decay adding up, volatility decreasing, all of those would help me make money on this position. Now, I do give up the home run profit potential. We talked about that long call on GLD, booking that 100% return for us this week. We're not going to have that opportunity with the credit spread. That's just not the nature of a credit spread. We're looking for a higher probability trade, which the trade-off there is we do have a lower potential return. So as you can see, a mix of trade types is going to be beneficial. Okay, I'm not saying you should only use long calls, long puts, or only use credit spreads. I want to use a mix of both. It continues to work really well for us. Our NASDAQ Superstars program, we've used a lot of credit spreads so far this year. Okay, so over the past 4+ months, it hasn't been exclusive, but it's pretty darn close. But we've been able to close out of almost 50 winning trades and 2 losers since the beginning of the year. So you're going to have a much higher probability of success. Those trades can add up in a big way. They're not 100% returns. A lot of times with a credit spread, I'm targeting between 20 and 40%. It's very typical as far as return on capital goes. So we're going to have a smaller percentage return, but we're going to have a much higher probability of success over time. When you start to use a mix of these strategies, if you're not already doing so, highly recommend that you add the credit spreads to the mix as quickly as possible. It's going to give you more consistency, and you're not going to be so reliant on one type of market condition. That makes a huge difference over time. I can't stress that enough. All right. So that is the JP Morgan trade. That's potentially setting up for us. I have not placed this trade yet. It's on my radar. I'll take a look at it later on this afternoon, potentially even early next week. With 42 days left to expiration, we don't have to rush into it. We can wait and see if price action does decide to sell off early next week, and we can put it on next week as well. So that's another one that's on my radar for next week. All right. If you have any symbols that you'd like me to take a look at, feel free to type those in and I will give you some feedback on those as best I can. Otherwise, I'm going to start wrapping up for the day. If you have any questions as well, feel free to type those in. More than willing to get to those also. I will be back next week on Wednesday for our next midweek recap. If you have any questions between now and then, I'd love to connect and help out. Mike@netpicks.com is my email address. So feel free to reach out and I'll respond as quickly as I can. So enjoy your weekend, everybody. Robert asking about ARKK. Yes. Popular for right now, for sure. So I'm looking at the 130-minute chart here. You could take a look at the 195-minute as well. That's also another one of our favorites. Sorry, guys, I see a little bit of a move down on the NASDAQ, so I'm trying to take a look at my platform here. Okay, so on ARKK, on the 130-minute chart, we've seen a nice move to the downside. No doubt about it, price action has been firmly lower. Would I initiate a bearish position here now? No, I think you're chasing at that point. I think you're going to want to hold off, wait to see if price action decides to bounce. Okay, now we have seen price action come up, and it has bounced over the last 24 hours. It's up 2.25% today so far. So if I were to place a trade right now, what would my outlook be? Well, looking at our pulse indicator down at the bottom, we have had yellow and green bars the last few days. That indicates an oversold extreme. When I see that happen, that has me interested in potentially selling an out of the money put spread, looking at a neutral to bullish position, looking for a bounce in the near term. Now, am I saying this thing's going to go back up to the highs? No. Am I saying it's going to move higher for the next 3 months? No, I have no idea what's going to happen over the next 3 months. When I see an oversold condition like this, my outlook is for the next 3 to 20 days is very typical. All right. 20 days being on the longer end of that spectrum. So in the near term, I am expecting, no surprise that we've bounced higher today because we did get oversold, very repeatable pattern. So if I were putting on a trade today, I would lean a little neutral to bullish. If you're waiting for another stab at the downside, I would want to see price action bounce a little bit further. Okay, I'd rather have it try to get up towards my dotted white line there. That's my midline. I'd like to see it get a little bit closer there before taking another shot at the downside. So if you're already in a bearish position, I don't have a problem holding. If you got some profits, move that stop down, try to lock in a little bit of profit. I would not initiate a new bearish position here yet. And then if I were forced to place a trade right now, it would be selling it out of the money put spread. That's my view on ARKK. So hopefully that helps, Robert, in giving my outlook. HZO. I don't know if I have that one. Let's see if I've got some data here. Let me take a look. Steven, are you trading HZO? Are you just trading the shares of stock, or are you trading options? The reason I ask, if I take a look at the options, they're not very liquid. I'm not saying you shouldn't trade it. Just be cautious on these products that aren't ultra liquid. It can be more difficult to get fills on those trades. And let me see if I can pull up the chart here. I just didn't have the data loaded up, so I'll have to wait for TradeStation to bring in the data for me. Okay, so on HZO, it's again, no surprise, it's been in a bullish uptrend. A lot of stocks have been, right? So at this point, if you've got a bullish position on, you can continue to ride it higher. I would continue to move my stop up, right? Have worst case, have a little bit of profit booked, because with so many overbought conditions here, this market could pull back in a hurry, right? So to expect this historic move to the upside to continue indefinitely, that's a stretch. So if you're bullish, continue to stay cautiously bullish here. Would I initiate a new trade? No, I think you're chasing at this point. If you're looking to put on a bullish trade, the stock's already moved. Since the end of April, it's moved from 45 up to 65. That's a huge move. That's a $20 move on a $45 stock. That's huge. So you're chasing at this point. Notice how my pulse indicator down at the bottom is starting to plot yellow. We're starting to get our first overbought reading here today. I typically, in order to sell a credit spread, like we just talked about here a few moments ago, I would want to see 3 out of the past 5 bars plot yellow. So in order for me to initiate a new credit spread here, I would want to wait into next week to see if I can get a few more yellow bars there, just to make sure price action exhausts itself on the upside. So again, if you're currently in a position, if you're leaning bullish, stay cautiously bullish, lock in a little bit of profit, move that stop up. If you're looking to initiate a new trade, I would not chase on the upside. I'd wait for wait for a deeper pullback before you initiate anything new on the long side. Yeah, you're looking, Steven, you're looking at the options. Yeah, I don't have a problem. I mean, what I'm looking at here is the June monthlies, the ones with 42 days left. This stock doesn't have weeklies. But when you take a look, I mean, you've got some liquidity in here. I mean, the options right around the at the money strike are probably tradable. There's just not a ton of action in here. Normally, what I like to see, take a look, Steven, at my screen here. Take a look at the volume and open interest numbers on these options. I'm talking about, right around that 60 to 65 strike range. I mean, there's some activity, there's some volume and open interest there, but compare that. I'm going to go from one extreme to another. Compare that to what you see on Apple. Now, yes, I did go to another extreme, but this is typically what I'm looking for, where you've got liquidity, you've got volume and open interest spread across many different strike prices. I mean, you've got good volume and open interest across almost every strike price here. So that's typically what I'm looking for, a little bit more action. If we go back to HCO, you just have to know that it might be a little bit more challenging to get fills on trades. You may have to give up a little bit on the price, for example. Not a deal breaker. If you're trading small position size, you can probably trade this product. Just be cautious. Yeah, it definitely broke above the previous high, Steven, but going back to the chart, I mean, going back to that low back on April 21st, the low on April 21st was at 45.15. Okay, since that time, this stock is already up above 65. Okay, I mean, over the past little over a week, I mean, this stock is up $20. It's a 50% move, and that's a huge move. So you just have to know that, okay, we just started to get a one standard deviation move. That's what that yellow bar means on my pulse indicator. So just from a technical perspective, only 13.6% of all occurrences fall outside of this range on the upside. I'm not saying it can't move higher. It certainly could. It's just not statistically probable. That's why I'm saying don't initiate a new long trade here until you get a deeper pullback. A stock moving up 50% in a matter of a week's time, it's pretty impressive. So, I mean, I would, if it were me, I'd wait for a pullback first. Let it reset a little bit. Let it work off some of that big move before you jump on board anything new. And Kevin, good afternoon. Yeah, thanks for joining us, Kevin. We're actually just about ready to wrap up for the day. We've been live for about the last 40 minutes or so. This will be recorded. It's being recorded, and you'll be able to watch a recording on our YouTube channel or on our Facebook page. So if you want to go back and start from the beginning, we talked through a number of different trades here today. So if you want to go back and review the recording, feel free to do so. Then if you have questions while reviewing the recording over the weekend, you can always email me. Mike@netpicks.com is my email address. I'd love to connect and help out. All right. So guys, any last minute questions, comments, go ahead and get those typed in. Otherwise, I'm going to wrap up here for the week. Again, enjoy your weekend. Enjoy celebrating all the mothers out there on Sunday. And I'll be back with you guys on a Wednesday. We'll send out an email reminder on Tuesday. We're going to try to be live on Wednesday at 12 o'clock Eastern. So we'd love to have you join us on Wednesday. All right. We'll talk to you guys then.